Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on April 22nd, 2017. First, a quick week update. What did we ultimately do this past weekend trade? And really the primary focus of this update is going to be very specifically examining some of the risk that's going to face us this coming week. And for those of you unaware, uninitiated, there is a tremendous amount of volatility priced into this coming week. And of course, this coming week, there's a myriad of risks out there, including the French election, the release of the possibility of a new tax program. I mean, I can go on and on of, again, kind of a myriad of risks coming this week. But it does, in fact, appear that the markets are pricing quite substantial risk to this French election. We'll come to that secondarily. First and foremost, let's take a look at this this past week. So the line directly in the center of your chart there is 23.49. Now, I've been talking about this level, okay, for months. It happens to be kind of the central point of trade. Here we go all the way back into February. Legitimately, we have been looking and examining this level of 23.49 inside of the S&P futures for months at this point. It's no surprise that when the markets are facing some more substantial risk in this coming week, that the market ultimately runs and goes back and hides at its happy place, which happens to be the center of trade over the last few months, 23.49. So there isn't a tremendous amount to discuss in this last week of trade, other than really two factors. Number one, we did rally up. How much? Well, the SPX, okay, and I'm gonna start with the SPX over here. The SPX started the week, and again, what I've done is I've gone and I've backed up. All right, here, think back. We're actually looking at last weekend. So I like to assess from like Sunday until, through the entire week. And here we are on the following Saturday. So looking back from, of course, April 16th, the S&P, specifically the SPX, was trading at 23.29. And we closed the week roughly at 23.49, which is rounding over here. So we push mildly higher. Here's the interesting aspect of this, and one of the reasons I really like to do this kind of brief recap and look back. If you looked from last weekend, the marketplace was expecting approximately a $32, $33 move. Okay, did we get that? Now, this doesn't say, this $32 expected move, it doesn't say that we're going to move up 32 or going to move down 32. We're supposed to end up inside of that range. And I keep mentioning these week in and week out and day out. If you're joining us on TheoTrade every single day, we talk extensively, okay, about expected move. Why? Why do we talk so much about expected move? Well, just do some quick math over here. What's 32 bucks, okay, added to 23.28? You're like, boop, 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 boop. All right, so you got 23.60. Did you look back at this last week of trade? Okay, don't worry about the line on the screen. That's where we're currently at. But you look back at 1, 2, 3, 4, 5 days of trade. And again, where did we start last week was right down here. And again, I'll just kind of mark it on your screen for a second. Right here is where we started kind of the week of trade and gapped up albeit very, very slightly higher. But from this 28 level, okay, what we were expecting in the movement was about plus $32, or could have been minus $32. But in this particular week, what was the high in the SPX? And you'll see almost to the penny, okay, we were just north of 23.60. Remember, a moment ago when I was showing you in the expected move, okay, I was rounding. But if you took 32.71 and literally added it to 28.95, guess what? You pretty much get the high of the week inside of the SPX. So no wonder I spend so much time on these expected moves. We moved from this 28 level, okay, from the previous week, and in 5 days of trade, the upper band that we hit just so happens to be what the option market not only predicted. It's not like a self-fulfilling prophecy. You have to recognize that the option market, it's definitive. People are trading this $32, $33 move. There's skin in the game. That's why this is not like some craze like Fibonacci, you know, I got my 618 right here. Okay, they're trading tens of thousands of contracts in the SPX, and it's driving markets, okay, to the edge of the expected move and snapping them back in. And the reason I'm spending an extra minute or two discussing this is because the markets didn't do anything unusual other than, well, number one, we hit the right onto the edge of the expected move. And number two, one thing that really stood out to me in this trading week, we had fairly substantial ranges on an intraday basis. And I don't know if anybody recognized that, because if you kind of zoom out for just a moment, like maybe it didn't do justice, but look at the ranges of trade of the day. We had some great intraday trading ranges that, again, if you trade on an intraday basis, take advantage of. Now, without further ado, okay, last week, it's ancient history. You got to look forward. What I've done here in the SPX is a little bit of, work prior to starting this video. And that work, ultimately, I just went out and I marked on your screen, okay, number one, where the SPX currently happens to be, which once again, right here is at 23.48 and change. That's what that little hash mark happens to be. And that little hash mark just extends out approximately 5 trading days. Why? Just going to extend out to the end of the week. Now, I'll zoom out for just a moment. What I want you to see, okay, look how wide these hash marks happen to be. What are these? Okay, what is this? This is all the way down at 2,300. This one is just shy of what? 1,400. And we're sitting deadly in the middle of that range, which happens to be none other than, here we are, 23 roughly 50. So if you look at these little hash marks, they're pretty much plus $50 and minus $50. Okay, and you could follow along, and play the TheoTrade at-home game over here and make your own little hash marks on your screen. Okay, but what they represent is none other than, check this out, the expected move for this week. And when I, building up to this for just a second, why am I building up to it? When was the last time that you saw a $47 expected move for a week? I pause for a second because we haven't seen such volatility, okay? You got to go back, months and months. You got to go back to November. You got to go back to just prior to the presidential election to see this. Now, the risk this week, I'm going to examine it even deeper. So we have a $47 expected move riding on a Friday expiration with a 18 volatility. Now, for those of you who don't know what an 18 volatility is, it's kind of like looking at the VIX. The VIX right now is just shy of 15, okay? But the VIX is 30-day volatility. Well, this is like the VIX for the next, 6 days. This is the VIX for the next week. It's sitting at about 18 and almost a $50 expected move in the SPX. Now, why should you care? If you go back to the previous week of trade, like I am doing right now on Think Back, all right? Here's, any given week, here was a $32 expected move, which we got every dime of $32 of movement this past week, all right? You look at any previous week, all right? So I go back here to the 9th, for example, and I pull up an expected move, and what do you see there? $23 expected move. Most recent weeks have had about a $22 or $23 expected move, okay? I can go back the week prior to this, and again, look out 5 days, it's a $22 expected move. You can go back month after month after month after month. You're not going to see any more than that. The last time we had, appropriately heavier expected moves like this, right? You legitimately have to go back to the election. Now, the election, I want to show you, there's some heavy volatility, right? There's a 30 vol on a $71 expected move. Now that was the election, which was, well, a wild and woolly move. Look at that. Okay. This is the move that ultimately came from what? Oh, right around the 2075 and exploded us inside of a week here, almost 100 points higher. Nevertheless, okay, the only thing we have to compare it to in recent history is that election there. So the French election, though, it appears that this coming week, it's front-loaded risk. And what that means, okay, is that the risk is priced more heavily even into, okay, the Monday expiration is almost to a 22 vol. The Wednesday expiration is sitting at a 20.4 vol. And then, of course, Friday dips down to 18. So the risk is going to be front loaded to this week. So basically, what am I telling you? Okay, strap on your helmet there for like even Sunday night when the futures reopen. You better be tuned in and turned on because we're going to be moving. Right? There's results coming out of the French election. It doesn't matter so much like the French election, okay? Because if you've listened to any news about this election, right, this is only the first stage of it. Our market doesn't seem to care, right? So what I say about the first stage of it, all right, so, you know, this Sunday, April 23rd, is the French election's the first stage of it. It's probably only going to narrow it down to 2 candidates, and then May 7th, we got to go through all this again, okay? But our market isn't really pricing it that way. And, you know, I'm kind of coming to the conclusion that the risk in our market, it's just being masked by this French election. Like, there is some very serious front-loaded risk, though, over here. By the Monday, close of this Monday, we have a $35 expected move. Okay, just to compare that to any given weekend, most weekends, we have about half that risk. I mean, legitimately, you can look at any given weekend out there. I know I have us to the election, but all right, look at any given weekend here. And let me just back up, for instance, to last week. And you look at like a Monday, and here's a $12 expected move, right? And this was just, you know, for the April 10th expiration, or, you know, fast forward another week to the 16th. And what did this past week look like? Okay, and the answer is, you know, the April 17th expiration, there was $17 of risk. Okay, we're sitting on almost $36 of risk. That's a big move. That's more than we've typically been seeing, okay, in an entire week inside of the SPX. So the risk we know is front loaded. Now, in addition to knowing that there's a ton of risk packed into the market this week, the first thing you should kind of think to yourself, what should my allocation be? Probably a little bit smaller than you normally trade. Okay. The next question, are there any other signs, okay, of pending risk, pending fear? And so the bonds, sure, the bonds, and I've been pointing this out now for a long period of time, the bonds are already in a duck and cover kind of position. Even though the bonds backed off, this is absolutely nothing. Okay. The bonds backed off this week. You know what? They didn't back off this week. If you take a look at the week, they're still up on the week. Right. And I just, you know, walking people into this, they're like, well, the bonds didn't back off. No, the bonds are actually still displaying like risk is full on out there. But there's also another very, very curious reading, and that happens to be in skew. And for those of you, if you've never looked at skew before, it's all right. You know, deep breaths out there. Skew is not something that you necessarily have to look at on a day-to-day basis. But what skew is, it looks and measures the out-of-the-money puts versus the out-of-the-money calls in the SPX. Okay, skew closed on Friday afternoon, okay, at a 148 reading. And there's only really like 1, 2, all right, maybe 3, 4 readings, okay? There's possibly a 5th one in there. You only have 4 or 5 readings in the history of measuring skew, okay, that go anywhere near as high as the skew currently is. So what this ultimately means, traders are covering their tail risk. And tail risk has to do, if you've never heard that phrase, kind of tail risk out there, it has to do if you looked at a distribution curve, and this is a normal distribution curve. Okay, tail risk is massive event risk way out here. Okay, And the chances of an event happening way out here in the distribution curve are very, very low. Okay. But the skew right now being at a 148 is saying that traders are actually hedging that way out event risk. All right. Now, to dig a little bit deeper here than just looking at the SPX and saying, okay, there's risk, I went through and I examined most of your major sectors. So I know a lot of people are focused this week. They're like, but Don, what about Google, man? Yes, there's earnings in Google. Whoop-de-doo. Okay. To show you the earnings in Google, they're only pricing in a 34% implied volatility in Google. Now, why do I make that prevalent? Because the entire SPX right now has elevated volatility. So whether it's, Google has earnings and Amazon's got earnings out there, a 37 vol, it's nothing. The SPX has a volatility that's getting up there that high. What else has earnings out there? And Microsoft and a few others. So yeah, there's some big tech companies, but let me show you tech in general. The reason I think that this is important is tech this week with 6 days. What kind of risk is tech showing? And the answer is in the next 6 days, it only has a 17 vol. Now, why I'm pointing that out is because if you remind yourself for just a second, the SPX over the next 6 days has an 18.4 vol. Technology is not displaying this monstrous amount of risk that the SPX is. Okay? Even though that there's still some major earnings out there. So this got me thinking, and I started going through all these major sectors. I mean, one of the first sectors I went to, like XLU. For those of you unaware, it's the utility sector. It's at a 16% volatility. This is just this next week. Okay. What other sectors? I was looking at like home builders over here. Well, the home builders showing any risk? All right, they're at a 21 vol. And then I started going to like XLK, which is technology specific. All right. And just looking through, and again, XLK in this case, which is just looking through the different levels, okay, and the different sectors for what their risk metric is. And then ultimately it kind of hit me. Go take a look at like emerging markets. Emerging markets are sitting on almost a 26% volatility this week. Okay. This is a highly inverted volatility. Lo and behold, the highest volatility of the week in terms of a major sector is undoubtedly going to be the XLF. The XLF is sitting on almost 27% volatility for the week. And to compare that, listen, most of your major financial companies, your Goldman Sachs and your Bank of America and JP Morgan and Citi, they have all passed through earnings already. Yet this sector is sitting on a pile of risk. So we deem that the French elections are causing, a possible ripple effect into the financial products themselves. Currency risk is extraordinarily high. Emerging market risk is extraordinarily high. Obviously, financial risk is extraordinarily high. Looking at a product like Goldman Sachs is still expected to move almost $7 throughout the course of the week. And if you haven't looked at Goldman lately, kind of a fun chart, but I'll zoom in a little bit. Goldman's been on just a wild ride after their earnings announcement. And again, falling from a recent high of 255 and change all the way down to the low 200 marker here, and continues to exhibit and kind of exacerbate risk over here. So obviously the financial products, it needs to be a huge area of focus in this coming week. Not so much, the earnings announcements from your Google, your Amazon, your Microsoft, your Intels and so forth. Again, I'm totally aware that the earnings are going on. But we're facing much larger, as I said, front-end loaded risk. Think about the levels here, okay? Upper end of the SPX range should be in the neighborhood of about 2395, right? The downside of it, almost 2300 on the button. Again, one of the largest expectations of risk since the presidential election. Prepare yourself for it, okay? Think about, again, cutting allocation size, realizing again that the risk is very much front-loaded. Monday, all right, Wednesday type risk over here. By Friday, it's actually displaying that the risk kind of abates a little bit. No need to really focus on a calendar that much. This is predominantly event-related risk due to these elections, due to this tax program that's coming out. Again, keep your head in the game throughout the course of the week, and we'll be updating you, all right, Monday, Tuesday, Wednesday throughout the chat room, and of course, in these evening videos. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.